First up, an exclusive conversation with our market guru of the day, Hiren Ved.
Hiren, good to have you on the show. What are you expecting in the light of the recent volatility? It's going to be a sharp, short correction, or do you expect it a protracted period where money making becomes difficult?
Hi Udayan, hi Abba, thanks for having me on the show. Yeah, I think, we usually, when the first leg of the bull market from the bottom gets done, you usually have some sort of volatility. It's quite possible that once this volatility subsides, we may have the headline indexes going into some sort of a consolidation move, while individual stocks may continue to do well. That's usually the next phase of the bull market, where you have probably a consolidation at an index level, but then individual stocks and sectors will do what they have to do before the Nifty catches breath and then moves on to the next level. And I think we are going to probably see something very similar. We are currently going through a transition phase where we are moving from, probably the baton is going to be handed over from excess liquidity to earnings growth. And usually that transition period is a little bit painful. So we have to go through that.
But you're sure in your mind that this is not a end of the bull run that we've seen for the last 12-15 months? Because another hypothesis could be that easy money is now over, and easy money was at the core of this bull run, and now we will probably see a different kind of a market and not the bull market that we have known for the last 15 months.
Certainly this is not the end of the bull market for sure, but it's a different phase of the bull market, right? And I think as I mentioned, as opposed to the first phase where it kind of lifted all boats together, I think from here on you may see a much more measured bull market, where the broad market kind of consolidates, but you have individual sectors and companies continuing to do well. I don't think money is just kind of completely gushing out, right? It's the incremental change in liquidity that matters. Again, I'm not a global macroeconomist, but if you look at two other instances in the past, which is between May 04 and the middle of 06, when the Fed funds rate went up by almost 400 plus basis points, the Nifty actually delivered a 45% dollar positive return, and so did all other global markets as well. And similarly, closer, when you look at the time frame between 2016 and 2018, when again Fed funds rate went up by about 230 odd basis points, and global markets still gave positive returns. And usually interest rate hikes are run concomitant with a very strong global economy, right? So we will have to see what the context is, but my sense is that we're going to see a very strong rebound in the Indian economy, and I don't think that higher rates are going to kill this bull market. They may tame it for a while, but they won't kill it.
Typically, going by past instances, when you move from the first phase of the bull market to a consolidation phase, as you just outlined, if you are correct, and this is how the story plays out this time, typically how long is this period of consolidation for, where valuations pull in a little bit, pull back a little bit, and earnings growth slowly delivers and the market starts to find its feet and move up once again? What is this intervening period? I mean, generally, what is the time length?
So then I think we've seen it as low as 6 to 9 months and probably as long as 3 years, right? And there is no fixed formula what it will be this time. But my sense is that if our bet that the earnings growth is going to be quite healthy, 25% plus kind of compounding growth over the next few years, then I think the market on a forward basis is not that expensive. So my bet is that it could probably be a few quarters sideways movement before we start to move again, because then people will start looking at earnings in 23 and 24. Obviously, there can be a lot of imponderables. You can never say for sure. But I think as things stand today here, my sense is that, earnings has shown its hand. I think the way the Indian corporate sector has responded to COVID when nobody expected, we got a 20% earnings growth in 21 and potentially a 25% plus earnings growth in 22. I think we are on course for maybe a few quarters of sideways and then a move back up.
So does this then change your strategy on specific sectors or themes that perhaps you were looking at, Hiren, or were you already kind of anticipating this slowdown?
So, Abha, I think, as the going goes, that every bull market has a new leader, right? And I think that the bull market, which started from the lows of March 2020, already showed its hand with, the IT sector or the technology sector being the clear leader amongst the larger sectors, along with certain smaller sectors like specialty chemicals and so on and so forth. And we've also seen that the leader of the prior cycle, which is the banks and the private banks and the financials, which were leading the previous bull market, are now lagging it very clearly, right? So I think that, there may be new leaders who will join, but I think pretty much it looks like, in our view, that technology will continue to be in the leading seat, and it will be joined by a few other sectors which continue to deliver very strong earnings growth. Now, mind you, these sectors itself, when they are leading, doesn't mean that they don't go into a correction or a sideways movement. But very seldom does the leadership change so quickly in a bull market, right? So I think we're going to do more of the same. And along with technology, I think a sector that at least we are betting on is the consumer discretionary sector, which got significantly impacted during COVID. I think as things open up, and I know it's the wrong time to say this when Omicron is on our backs, but I think eventually this phase will also hopefully fade out in a couple of months. And I think there is a lot of recovery and earnings power that is still left there. So I think a combination of technology and consumer discretionary and a few export sectors should continue to lead the next bull market.
Watch the entire interview with Hiren Ved on Business Today IN and also on our YouTube channel. RBL Bank in focus after the stock plunged over 20% in trade today, the biggest decline since listing in 2016 after its top executive stepped down. In a surprising turn of events, Yogesh Dayal, RBI's chief general manager, was appointed to RBL's board by the central bank for 2 years. The same day, RBL Bank informed stock exchanges that its MD and CEO, Vishwavir Ahuja, a veteran banker, has gone on leave with immediate effect. Rumours about the bank's financial health have been doing the rounds following Ahuja's sudden exit. Meanwhile, Rajiv Ahuja has been elevated as the interim managing director and CEO of the bank. The sudden development led to uncertainty among investors, leading to a drop in the bank's share price. RBI issued a statement with respect to the speculation. The central bank said RBL Bank is well capitalized and the financial position of the bank remains satisfactory, and there is no need for depositors and other stakeholders to react to speculative reports. Many were not happy with what experts say was a late response from the RBI. Brokerage firms also turned cautious after RBI's appointment. CLSA reduced its target price on the stock and said the move will lead to near-term uncertainty. ICICI Securities downgraded its rating on the stock to sell due to the sudden developments. Latest from the IPO season, HP Adhesives had a good start to its Dalal Street journey. The scrip listed on the bourses at a premium of 16%. The decent debut came after the IPO was oversubscribed by 20.96 times. The issue had witnessed a strong investor response despite high valuations. Though the stock listed with decent gains, according to experts, weaker global market sentiment impacted listing gains to a certain extent.